At the food court of the biggest warehouse club on earth, there's a hot dog and soda combo that costs $1.50. It cost $1.50 in 1985. The year the first Nintendo arrived in America. 40 years of inflation say that combo should run about $4.50 today. It doesn't. Because when an executive once suggested raising the price, Costco's founder gave him an answer that became corporate legend. If you raise the price of the effing hot dog, I will kill you. Figure it out. Companies don't usually threaten homicide over sausages, but that hot dog might be the most disciplined business decision in American retail. It loses money. On purpose. Forever. And it's the perfect introduction to the strangest giant in commerce, a company that sells $270 billion of merchandise a year and tries as hard as it possibly can to earn nothing on any of it. This is Costco. And once you see how the machine actually works, you will never look at that little membership card the same way again. To understand Costco, you have to meet a lawyer named Sol Price. In 1954, he opened FedMart in San Diego, one of America's first discount retailers, and spent 2 decades learning a lesson that broke every rule of his industry. The less he marked up his products, the more money he made. Volume beat margin, every single time. Price became a kind of prophet of cheap. Sam Walton openly admitted he borrowed more ideas from Sol Price than from anyone else. He even borrowed half the name for Walmart. Years later, a young Jeff Bezos would study Price's playbook while building Amazon. In 1976, Price pushed his lesson to its logical extreme. In a converted airplane hangar in San Diego, he opened Price Club, a store that charged customers an annual fee just for the right to walk in. And in exchange, Solzhenitsyn sold merchandise at barely above cost. Everyone thought it was madness. The membership wasn't a gimmick, though. It was the profit. One of his people was a young man who had started at FedMart at 18, bagging groceries. His name was Jim Sinegal. He absorbed everything Price knew, and in 1983, with Jeff Brotman, he opened his own warehouse in Seattle and called it Costco. 10 years later, teacher and student merged their companies into one. Sol Price invented the best business model in retail. Then his apprentice spent 40 years refusing to change it. That refusal is the entire story you're about to see in the numbers. Walk into a supermarket and you're looking at around 30,000 different products. A Walmart supercenter carries over 100,000. Costco, a building the size of 4 football fields, carries about 4,000. That is not a limitation. It's a weapon. One brand of ketchup, a handful of TVs. If Costco sells olive oil, it sells an ocean of one olive oil. 4,000 items means every single product moves an absurd volume, which means Costco doesn't buy cases, it buys truckloads, which means it gets prices nobody else on earth gets. It also means the store costs almost nothing to run. Merchandise ships on pallets, and the pallet is the shelf. No stockers arranging end caps. No backroom warehouse. The store is the warehouse. Forklift in, forklift out. And because there's only one of everything, each item carries the company's full reputation. That's why the return policy is famously, almost recklessly generous. No receipt, no time limit on most items. It looks expensive. It's actually the 4,000 item bet insuring itself. Every product must be good enough to defend the whole system. Every removed choice is a discount you can't see. Remember that number, 4,000, because it's the quiet engine behind every other number in this episode. One of his people was a young man who had started at FedMart at 18, bagging groceries. His name was Jim Sinegal. He absorbed everything Price knew, and in 1983, with Jeff Brotman, he opened his own warehouse in Seattle and called it Costco. 10 years later, teacher and student merged their companies into one. Saul Price invented the best business model in retail. Then his apprentice spent 40 years refusing to change it. That refusal is the entire story you're about to see in the numbers. Now for the rule that makes Costco famous inside the industry. Most retailers mark up merchandise 25 to 50%, often far more on clothing and accessories. Costco has an internal law. No item may be marked up more than 14% over cost. 15% for its house brand. It doesn't matter if it's a television, a rotisserie chicken, or a literal bar of gold. And yes, Costco sells gold bars. 14%. That's the ceiling. Think about what that means. Every retailer on earth wakes up asking, how much more can we charge? Costco wakes up asking, how much less? When a supplier cuts its price, Costco is famous for passing the entire savings to the shelf immediately, even when no competitor would ever know. The cap also transforms how Costco negotiates. Its buyers are legendary for dissecting supplier economics line by line, because when your own margin is fixed by law, the only way to lower the shelf price is to attack the cost. Suppliers grumble, then comply, because a single yes puts their product in front of the highest spending customers in retail. To a normal chief financial officer, this looks like billions in profit deliberately refused year after year, but the cap isn't generosity. It's the most disciplined customer acquisition strategy ever devised. If members trust that the price is always fair, they stop comparison shopping entirely. And that trust is about to show up on the income statement in a very strange way. So let's open the books. Fiscal 2025. Costco sold $269.9 billion of merchandise. The merchandise itself cost $239.9 billion. That leaves a gross margin of just 11%. For scale, Walmart runs about twice that. Department stores run 3 times that. 11% is barely a heartbeat in retail. Then subtract the cost of actually operating 914 warehouses. The forklifts, the freezers, the free sample ladies, more than 300,000 employees, $25 billion. And here's a detail to hold on to. That's just 9% of sales, the leanest operating cost structure in the business. Thanks to the pallets and the 4,000 items. Do the arithmetic, and the entire global retail operation, every television, every chicken, every gold bar, clears roughly $5 billion. On $270 billion of sales, that is less than 2 cents of operating profit per dollar. Selling things at Costco is a break-even hobby, executed with military precision, and yet total operating income for the year was $10.4 billion, double what the merchandise produces, which means half the profit engine is something else entirely, something that never touches a shelf. Membership fees, $5.32 billion of them in fiscal 2025, up 10% in a single year. Here's why that number is unlike every other number on the income statement. It has almost no cost attached. Nobody manufactures a membership. It doesn't need a truck, a freezer, or a forklift. When you hand Costco $65 or $130 for executive, nearly every penny falls straight to the bottom line. $5.3 billion of fees against $10.4 billion of operating income. Half of Costco's operating profit is the entry fee, measured against net income of $8.1 billion. It's closer to 2/3. The warehouse, the pallets, the samples, the $4.99 rotisserie chicken placed at the very back of the store. All of it is one elaborate machine for renewing a subscription, and renew it does. 92.3% of members in the US and Canada renewed last year. That is a retention rate most software companies would fire their entire leadership team to achieve. When Costco raised the fee in September 2024, the first increase in 7 years, members barely blinked. Try raising prices 7 years late anywhere else in retail, and the fee is almost invisible next to the behavior it unlocks. The average member household spends on the order of $3,000 a year in the building. $65 against $3,000. It's a 2% tax that members happily impose on themselves for the right to pay wholesale on everything else. So here's the reframe. Costco is not a retailer with a membership program. Costco is a subscription business wearing a warehouse costume. The 14% cap is the subscription's value proposition. You pay the fee because the prices feel impossible, and the prices feel impossible because the fee pays the profit. The loop closes perfectly. Now open the balance sheet, because the second secret is stranger still. At year-end, Costco held $18.1 billion of inventory, everything in every warehouse on the planet. And it owed its suppliers $19.8 billion. Read that again. Costco's unpaid supplier bills exceed the entire contents of every building it operates. Suppliers are financing more than 100% of the merchandise on the shelves. Here's the timeline of a pallet. It rolls off the truck on day 0. The 4,000-item discipline means goods move so fast they're sold in roughly 4 weeks. The supplier's invoice comes due around day 30. Your groceries were rung up, bagged, and gone before Costco ever paid a cent for them. The company's cash conversion cycle runs about 3 days. A typical retailer waits 1 to 2 months to see its money again. And it compounds. Remember the fees? Members pay a full year in advance. There's $2.9 billion of prepaid membership money on the balance sheet, collected for a service not yet delivered. Costco even owes its executive members $2.7 billion in accumulated 2% rewards. Cash members have earned, but not yet spent, which of course gets spent at Costco. Put it together, and the machine assembles itself. Suppliers fund the inventory. Members fund the operation in advance. Costco runs a $270 billion enterprise substantially on other people's money, and still finish the year with $14 billion of cash. There's one more piece, and it's probably in your pantry right now. In 1995, Costco launched a house brand named after the Washington town where it was headquartered, Kirkland Signature. Today, Kirkland is estimated at roughly $90 billion a year. About a third of everything Costco sells. Pause on that. As a standalone company, Costco's store brand would be one of the largest consumer businesses on earth. Bigger than Nike's entire revenue. Bigger than Coca-Cola's. The genius is in the constraint. Kirkland products are often made by the same manufacturers behind the national brands. Reportedly, at times, on the same production lines. But because the markup is capped at 15%, the quality arrives at a price the brand sitting next to it can't touch. At most grocers, the store brand is a margin grab. At Costco, it's another argument for renewing the membership. Notice the pattern now. The hot dog, the 4,000 items, the 14% cap, Kirkland. Every famous thing about this company is the same single strategy wearing different uniforms. Take what could have been profit and spend it making the membership feel unbeatable. One last mechanism, and it explains the gold. In 2023, Costco quietly started selling 1-ounce gold bars, and they reportedly began moving as much as $100 million of gold a month. Members were buying bullion next to the paper towels. Why would a grocery warehouse sell gold? Because of the 14% rule, Costco may be the cheapest reputable place in America to buy it. The cap turns even precious metal into a bargain. The gold is the loudest example of a quieter system retail insiders call the treasure hunt. Roughly a quarter of Costco's 4,000 items are constantly rotating. 1-carat diamonds, vintage champagne, kayaks, a grand piano at Christmas. Here today, gone forever. Members learn the rule fast. If you see it, buy it. Because next week, it won't exist. That's manufactured urgency. The same psychology that powers limited sneaker drops, running quietly inside a warehouse club. It's why members visit again and again without a single advertisement telling them to. Costco spends almost nothing on marketing. The inventory is the marketing. Here's the part that breaks economists' brains. Costco is famous for paying the best wages in retail. Hourly pay now averages north of $30 with real health care, and turnover so low it's measured in single digits once someone stayed a year. Wall Street analysts spent 2 decades telling Costco it was overpaying and leaving profit on the table. Now look at the ledger. Those expensive employees produce the cheapest operation in retail. That 9% operating cost figure, roughly half of what traditional competitors spend. How? Velocity. Each Costco employee supports over $800,000 of annual revenue, multiples of the industry norm. Experienced people, moving pallets instead of stocking shelves, in a building with 4,000 fast-moving items, simply produce more per hour than anyone else's workforce. It's the same lesson as the hot dog, applied to human beings. What looks like money left on the table is actually the machine's most profitable part. Costco doesn't pay well despite the business model. The business model works because it pays well. Zoom out and watch the flywheel spin. $192 billion in fiscal 2021, 223, 238, 250, $270 billion in 2025, with e-commerce compounding at 16% on top. That's 914 warehouses averaging $295 million of revenue each. Every single building, on its own, outsells many companies listed on the stock exchange. The cash flow tells the same story. $13.3 billion generated from operations against $5.5 billion of capital spending. Most of it new warehouses, and every new warehouse arrives with thousands of new memberships attached. More members, more volume. More volume, better supplier terms, better terms, lower prices. Lower prices, more members. Saul Price sketched this loop in an airplane hangar in 1976, and it has not stopped turning for 50 years. And the strangest part? It's barely gotten started internationally. 629 warehouses in the United States, and 7 in China. 7 in a market of 1.4 billion people, where the first Shanghai opening drew crowds so large the store had to close early. The flywheel has entire continents left to roll through. So what's the catch? 3 things. First, the machine has a single point of failure: renewal. With merchandise earning 2 cents on the dollar, essentially all the true profit hangs on members re-upping every year, forever. If renewal slipped even a few points, this model doesn't bend. It snaps. And the pressure point is generational. The next cohort of shoppers is being raised on delivery apps, not Saturday pallet runs. E-commerce is Costco's fastest growing segment, but it's also the arena where its warehouse magic matters least. Second, price. The market knows exactly how good this business is. Costco trades at more than $400 billion, roughly 50 times earnings. That's a valuation normally reserved for software companies attached to a business that sells rotisserie chicken. At that price, perfection isn't the upside. It's the assumption. Third, the subtle one: temptation. Sitting inside Costco is one of the largest untouched profit pools in world business. Raise the markup cap by 2 points, and billions in new profit appear overnight. Every future executive and every impatient shareholder will feel that pull forever. But the cap is the moat. Break the promise once. Get caught taking the extra margin once. and 40 years of compounding trust starts to unwind. Here's the lesson hiding in Costco's financial statements. The merchandise was never the product. The product is certainty. The certainty that inside that building, you cannot get ripped off. Costco sells that certainty for $65 a year at a 92% renewal rate and lets a $1.50 hot dog do the advertising. The best businesses don't maximize profit on every transaction. They decide, precisely permanently, where not to make money and charge for the trust that discipline creates. Next episode, the airline that makes more money selling miles to a bank than flying you anywhere. Subscribe. The numbers only get stranger from here.